You shouldn't even think about it until it's 50 to 1, in my opinion. It's coming out of the ground at 7 to 1. It's averaged about 45 to 1 for the last 100 years, price wise. And that was with a 16 to 1 geologic ratio. Now it's 7 to 1. It's disappearing. And the demand for it is out of control, with the U.S. government just classifying it a critical mineral.
When you do some research, you find that at local coin shops, there's a lot of people that are selling. And when that is done, and it will be done sometime soon, first of all, they're going to regret it. But second of all, without the people selling, it will explode. And just wait until gold also gets into all-time highs again. Once gold and silver are both in all-time highs, I think silver is going to turn into a rocket ship. He's got a target of $85 in a matter of 3 to 4 weeks. It could even be higher than that. I don't know.
In this powerful discussion, precious metals expert Andy Schectman joins monetary historian Mike Maloney to break down why silver may be on the edge of one of the biggest moves in modern market history. Schectman explains that the silver-to-gold ratio has become completely distorted. While silver comes out of the ground at roughly 7 by 1 compared to gold, the market still prices it at levels far above that natural ratio. For over a century, the average price ratio hovered near 45.1. But today's mining reality suggests silver is far more scarce than investors realize. At the same time, growing industrial demand and the U.S. government's recent classification of silver as a critical mineral signal extreme pressure building beneath the surface. Maloney warns that many retail holders are still selling at local coin shops, masking the true supply shortage. When that selling dries up, silver's price could accelerate violently, especially once gold pushes back into all-time high territory. Maloney highlights that when both metals break out together, silver historically behaves like a rocket ship, with price targets as high as $85 in just weeks. This video explores why the coming metals surge may unfold much faster than most investors expect. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now listen to the interview.
The fact that gold is up 70% and the S&P is up 16% amidst the greatest tech boom in history with the AI, and the insiders are selling $2 billion a week since June. It's not just Buffett. You got Bezos sold $7 billion in Amazon. You got insiders and board members of NVIDIA dumping a couple billion in stocks. You got Zuckerberg dumping, Jamie Dimon dumping, and the institutionals dumping, as the public is all in on stocks. The largest allocation to stocks they've ever had, 45% or so of the market is by retail investors. The largest exposure to options, which is speculation, and the largest exposure to margin debt, which is leverage, at all time, $1.5 trillion in margin debt, as the insiders are selling. And who the hell is buying billions and billions and billions and billions worth of gold and silver since November? Every month. We're net importers of gold for the first time in my career, and other than brief episodes, maybe ever. So who's buying all this gold? People at that level don't do things just for the hell of it. They know what's coming. At the same time, they're quietly exiting the equity markets as the public's all in. So I would say, whether or not Warren owns it, I think it is being accumulated by the most well-funded and well-informed traders in the world. And you can see that not only by the bleeding down of metals out of the LBMA, the massive deliveries way out of the ordinary every single month here on COMEX. Again, just the first 2 days of the COMEX contract, the December delivery, and I didn't see yesterday, which had been the third day. Day one, December silver contracts, 7,330 contracts stood for delivery. That's 36.65 million ounces, worth more than $2 billion. Not a record. April saw 11,692. And as mentioned further up in the daily delivery report, we're only into day 2 of the December deliveries, and there's already been 2.397 million ounces of gold delivered, plus a knee-wobbling 41.525 million ounces of silver issued and stopped. Those are in 2 days. You're talking billions of dollars worth of gold and silver every single month. Who the hell is doing it? That's the insiders, who are the most well-informed, the same ones that are leaving the equity market. You wonder if Warren is in there? Probably is, through some sort of a fund or whatnot. And when you buy stuff on the CME, there's no disclosure.
And it's in the 70s right now, I believe. And, it was I made some large purchases during COVID when it was up. I didn't nail 120 to 1, but I did get some that were way over 100, like 110. However, at 70, silver is still an extreme bargain at 70. It went to 30 in 2011. It went to 14 in 1980. And that day is coming again. But with the fundamentals underneath what's happening in silver, I would expect that we could go down way below 14 as far as the ratio. Silver's big move from the 4s into the 20s occurred while there was a silver deficit like there's been for the last 5 years. Then when it hit $48 in 2011, that spike, a whole bunch of people went out looking for silver. Takes a minimum of 5 years to get into production. And that's the reason you're seeing these small positive numbers. We had a deficit. The deficit went away, but there's this delay. And that delay is good because now it's saying that we're probably not going to get back into a positive situation with silver supplies until the 2030s. It takes a really high, the cure for high prices is high prices because it'll bring more to market, except to find a discovery, to turn it into a mine, and to get that ore above ground and refined into bars takes 5 to 10 years. There just isn't enough. There's not going to be enough for at least until the end of this decade. And that means super high prices. When you go to that market balance, less exchange traded products, that's 7 years of deficit.
In this explosive market breakdown, top precious metals analysts reveal why gold and silver are flashing some of the strongest accumulation signals in decades. Signals coming not from retail traders, but from the world's most informed insiders. Despite a historic tech boom and record enthusiasm around AI stocks, gold has surged roughly 70%, while the S&P 500 has delivered only a fraction of that performance. At the same time, major corporate insiders, including leaders from Amazon, Nvidia, Meta, and major banks, have quietly unloaded billions in stock, while retail investors hold their highest equity exposure ever. Behind the scenes, something far more telling is happening. Massive, continuous purchases of physical gold and silver. The U.S. has become a net importer of gold for the first time in many years, and COMEX delivery data shows billions of dollars in metals standing for physical settlement, far above normal trends. These aren't small buyers. This is elite, institutional-level accumulation. Silver's supply strain is even more alarming. With years of structural deficits, long production timelines, and rising industrial demand, analysts warn that meaningful surplus may not return until the 2030s. That imbalance sets the stage for extreme price pressure as global inventories continue tightening. If insiders are exiting stocks and flooding into precious metals, the broader public may be missing the biggest shift of the decade. Let's get into the interview.
Yes, I had you invert it so that it showed when silver is outperforming gold, this ratio is going up, not down. But you can also do the silver-gold ratio, but then the scales on the side are in 0 point something or 0.0 something. And our brains just don't work as well that way. I wanted it in whole numbers. And so the gold-silver ratio provides that. And this also, so whenever it's going up, silver is outperforming gold. But look at where it was in 2011, where it was in 1980, and then look at how undervalued it's been from 1990 until today. It is still an extreme bargain. It is dirt cheap. Now, look at what the average was, that red line going through all through the 70s. That red line, the 2011 peak, it only visited what was considered fair value against gold all through the 70s. That was like the natural balance of the gold-silver ratio was about 30, and that's what it hit. It wasn't. There was an intraday, I think, where it hit 30, not 31.7. So this must be end of day, or maybe, yeah, it's not weekly. It's end of day. And 14 in 1980. So from where it is right now, it's saying that it should outperform gold easily. It'll outperform gold 2.3 times, and it could outperform gold by more than 5.2 times. And gold is still, I believe, a minimum of a double in dollars. And so you take this 5.2 times 2, 10.4 times, and that is the minimum. But the gold silver ratio could easily, when it hit 14, there was a huge strategic stockpile of silver that the U.S. had. They've sold it all off. The above ground stocks were far larger than they are today, far, far larger. Today, we are in a situation, and you didn't have, derivatives trading was very new. You didn't have hundreds of ounces of paper contracts for each ounce of real deliverable silver. The potential to blast past that 1980 peak of 14 exists. So if you're at 73 and it goes to 10, you got 7.3 times the return on silver that you would get at gold, and gold doubling that. I mean, the potential here for silver is just enormous.
In this segment, precious metals expert Mike Maloney breaks down one of the most overlooked signals in the entire commodity market, the gold-silver ratio. For decades, this ratio has acted as a powerful indicator of when silver is historically undervalued. And according to the latest data, silver remains one of the cheapest major assets on the planet. When the ratio declines, it means silver is outperforming gold. And history shows that these downturns often come in explosive waves. Looking back at previous peaks like the major silver runs in 1980 and 2011, the ratio returned to levels signaling true equilibrium between the metals. Today's numbers sit far above those fair value zones, suggesting silver is still positioned for a massive catch-up phase. With gold expected by many analysts to potentially double from current levels, the leverage implied by a return to historic ratio lows hints at the possibility of multifold returns for silver. On top of that, modern conditions are far more strained than in past bull markets. Physical stockpiles are thinner, industrial demand is stronger, and paper leverage in the derivatives market has never been higher. If silver even approaches previous extremes, the upside could be dramatic. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.